Welcome back. So is there a bit of a risk building in a lot of the unsecured lending that's taking place overall across the banking system? That's the big question. It has been a bit of a point of debate. It's a small debate right now, but one that is definitely getting noted. So we thought we'll highlight a Fitch note that has come out. Fitch put some interesting numbers to this as well. Now, over the last 6 years, starting from FY18, the share of credit card lending as well as personal loans across the whole system, all loans put together, it's gone up from 7.5% to about 10.2%. Is this risk in the making, and can it impact the credit profile of some banks? Let's put that question to Saswata Guha, Senior Director of Financial Institutions at Fitch Ratings. He's joining in to tell us more about the report and, of course, some of the issues that it raises. Saswata, thanks very much for joining in. Good to have you on the show. So that's the main question, right? Is there reason to be a little concerned, given that this has been the leg where credit offtake has been built around the retail piece, and a lot of it is unsecured, high-yielding unsecured loans? What's your sense?
Yeah, hi, morning, and thanks for having me. Well, I think before we sort of dive into the risk appetite bit of it, I think let's talk about some of the positives also. And those positives are that, in general, if you see, the Indian banking system has been returning back to health. So in general, the overall buffers, the loss absorption buffers, have been improving across the board for both state and private sector banks. And at the same time, the overall operating environment, has been quite supportive. So a supportive operating environment from our perspective is good for continued business generation, of course, some degree of risk appetite. Coming back to your specific question, what we are sort of really, trying to hint at is the kind of risk appetite of growth we have seen in specific asset classes, in this case, particularly unsecured personal loans and credit cards when you look at it as a whole. And I think that is an area where I think our stance is that of a little more caution. Although I think on the overall scheme of things, given how the overall operating environment is panning out, we think that the risks are still somewhat manageable at the moment. But as we all know, I think the Indian banking space is an intensely competitive space. So when banks are specifically targeting at certain asset classes amid this intense competition, there is always scope for, one, misjudgments, two, inefficient lending, and three, as we call, mispricing of risk. And I think that, to us, is a bit of a concern, because, this, of course, is at a system level. Both these asset classes have grown quite substantially. But even at an individual bank level, you will see that there are certain banks which have doubled their personal loans portfolio year on year. And that, to us, is of course, a bit of a surprise, but also a concern, because when loans are growing at that fast pace, we have history, right, where our prior risk appetite has had an impact on banks' financial performance. So I think it is really a cautionary note from that perspective.
In fact, Saswat, I would like to go back in history. In the past, when we have seen cycles when the NPAs inch up, broadly, what has been the exposure of the system to credit cards and personal loans? Currently, it's 10.2%. What's the marker at which do you think we are now entering risky terrain?
Yeah, so that's an interesting question, because when you look at risk, we tend to look at risk from two perspectives. One, of course, is the quality of the risk itself. So which one would be looking at a sort of a pyramid structure, whether an entity is lending to the absolutely lowest last mile borrower, or actually lending to the higher income bracket. And two is the pace of that lending. So that also has an influence on the kind of risk and underwriting that a bank can do. And I think in the case of banks, we don't think that they are really underwriting the last mile borrower in this case. But I think the challenge is the pace of growth and the competitive dynamics around it, because everybody seems to be chasing those particular asset classes. And of course, what we have seen is that as a result, there's been a lot of significant growth in those segments. To put it in context, if you look at the last 5-year compounded growth for the system as a whole, that comes to around roughly around something like 9.6 to 9.5%. When you look at the unsecured category, that's almost 18%. So that's always been almost double that of the compounded growth for the system as a whole. And I think clearly, there are certain risks building up in these pockets that we just need to be aware and careful of. What we are not saying is that the pace of risk building is the same that we had seen, say, back in 2010 to 12, where certain asset classes CAGR growth was over 40%. So I don't think that kind of exuberance is yet there. But having said that, I think at the end of the day, we must not forget that these are still unsecured loans, which tend to be most vulnerable when operating environments, start turning difficult. And I think it is really in that context that we are sort of viewing this picture.
Saswata, your note goes on to say that you've made negative adjustments to 3 Indian banks' VRs, which is Viability Ratings, to reflect this deterioration in risk profile. Could you tell us which are these 3 banks? Possible for you to share?
Yeah, so the 3 banks, this is all public. So the 3 banks on which we currently have these adjustments is PNB, Punjab National Bank, Union Bank and Bank of India, but that's got more to do with their past risk appetite, which continues to sort of weigh on their financial profiles, even though the numbers are improving. But we tend to look at 4-year averages because we are looking at some of these matrices through the cycle, and therefore, as a result, we continue to have risk profile, risk appetite as a negative adjustment. But that is not to say that if we continue to see strong risk appetite in particular asset segments coming across from other banks, we may take a similar view as well, where we are viewing some of this risk taking to be a bit on the uncomfortable side. So yes, I think overall, one must remember that I think Indian banks, at least at an operating income level, don't have a lot of leeway. The pricing power is weak, so a lot of it is ultimately dependent on growth and the way, of course, margins are managed. But as we've seen over the last maybe 5 to 6 years, a lot of the earnings growth has essentially come because of the credit costs coming under control. So I think that is one area that banks have to be absolutely, be vigilant about.
So your own estimates say that obviously capital buffers have gone up in the last couple of years, right? And your own estimates say that system-wide, CET1, we're at just above 13%. Wouldn't that provide a cushion, or could we be in a position where these defaults happen and they start to hurt? We're also talking about an environment where eventually perhaps there's going to be a move towards the ECL regime, the expected credit loss regime. But surprisingly enough, apart from Canara Bank, I think no other big lender came out openly stating how they want to move towards ECL buffers. Is that a concern?
Well, I think there'll certainly be certain capital requirement, coming out of the whole IFRS ECL migration. Of course, the regulator does have, the ability to sort of spread it out over a course of, I think, 4 to 5 years. So I think on the whole, whatever numbers we have crunched, we don't think it will be unmanageable for the system. If you talk about unsecured loans, those anyways need to be provided 100% from the moment they are delinquent. So I think from that perspective, if there's a huge stock of personal loans on banks' books, I think when they move to an ECL, they obviously will have to proactively and preemptively sort of provide against these loans. But yes, I think, when you talk about capital, the thing about averages is that it's an average, right? It tends to sort of smoothen out the relativities. But if you sort of were to deep dive a little more in terms of what this 13% means, I think if you look at it in the context of the state banks, that 13% goes down to something like 11.1 or 11.2%, whereas for the private sector banks, that's upwards of 16%. So there's a reasonable difference between the capital, the CET1 ratios of the state banks and the private banks, which of course then starts speaking about the relativities in terms of the ability to absorb, unexpected stress.
Saswata, just one more question. I mean, if you look at a lot of the risk-weight assets to advances for some of these banks, they're pretty favorable levels. It's not, bad at all. In fact, Abhishek was also pointing out for some it's closer to around 70% as well. Doesn't that provide some kind of comfort? Because even if you're looking at, like you said, loans are perhaps higher to retail, but I mean, if you look at just this ratio, it should provide some comfort, right? Doesn't look like the risk is very high on that count, at least.
As we have said in our piece as well, you're right. We're saying at the overall level, we do see the risks to be relatively manageable because the overall environment also is relatively benign. So potentially, I think if the risks are controlled within the levels they are, perhaps, maybe banks will be in a better position to weave out of it should the cycle turn. But having said that, the overall number that you're looking at, one must remember that still a large part of the overall balance sheet is driven by corporates and secured retail. And I think those are areas where banks continue to be very picky and choosy when it comes to onboarding risks, perhaps because, there are lessons of the past when it comes to concentration risks and so on and so forth. But I think in order to sort of offset, some of that low risk appetite, I think what we are seeing banks, doing is sort of turn up the tempo in terms of the unsecured retail. Perhaps because of its granular nature, they believe that they will be able to manage the risks better. But the fact is that any kind of unsecured loan is generally the most vulnerable and the first to go delinquent whenever the cycle turns. And therefore, from that perspective, I think banks have to be cautious because at a pre-provision level, even though the buffers are improving, I mean, as we have seen over the last 5-6 years, it is not a huge buffer. I mean, that buffer can get extinguished very easily. And therefore, tight control of asset quality, in our opinion, continues to be the primary driver of earnings for Indian banks. I mean, at the end of the day, more than 70% of their income is coming from, interest. So clearly, I think credit costs are one of the things that, or one of the key variables that ultimately decide the sustained earnings and profitability of any bank.
All right, Saswata, interesting thoughts there. Thank you for joining in, and plenty of food for thought as well. We'll take a quick break. On that note, on the other side, we'll get you excerpts from our conversation with the S. Narain of ICICI Prudential AMC. Stay tuned.